Hello, everyone, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to clarify great capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way to exit highly appreciated assets tax deferred so you can create, preserve, and grow your wealth. I'm your co host, Pearson York, filling in for Brett Swarts. And each episode, I'm joined by some of the best wealth, business, real estate, and leadership individuals in the world to share ideas, deal stories, and inspiration so together we can make complex tax deferral strategies simple and passive income plans achievable. As always, we're streaming on expertcresecrets.com, the Capital Gains Tax Solutions YouTube channel as well. And so please rate, review, and subscribe that. It really helps us out. If you find this content super valuable, I'm real excited about our next guest. He is the founding CEO of InvestOnMainStreet.com, a private equity firm. Specializes in multifamily apartment communities and some alternative investments in oil and gas. They got over 400 million in their portfolio, over 3,000 units. And also he's the co-author of the best-selling book on Amazon, Persistence, Pivots, and Game Changers. So please welcome Patrick Grimes. Patrick, how are you doing today, man?
I'm doing well. Thanks, Pearson. Glad to be here, and I appreciate the introduction.
Yeah, absolutely. There was a lot more on that bio. I'm not going to lie, everybody. So I'm going to ask Patrick real quick to go into his story a little bit, and he can tell us a little bit more about it. I didn't want to take away your thunder, man, because it's pretty long. So
yeah, no worries.
Let's go.
So we Invest on Main Street are currently doing very low risk investments in workforce housing, multifamily in the southeastern states of Texas. We are also doing some oil and gas wells and some alternative assets investments, but all cash flowing, appreciating, tax advantages, kind of our core value. And I think definitely recession resilience, because I started out back in 2007, and in 8, 9, and 10, I was into some heavier lifts, new development, residential pre-construction, and I rode that down hard. So I saw what happens in a recession when the demand shifts and you see the economics change overnight. And so that ever since then, I've been thinking to myself, hey, what if the next year is the year that the market shifts again? So I've been structuring deals in a very low risk way for capital preservation and wealth building in recession resilient markets for tax advantages ever since. And it's been going great. We've started small and traded up, and now we're at a fairly good size with a great portfolio of properties and returning very good returns.
Awesome. And so there's a ton of questions there that I really want to dive into. But before we do, what are one or two strengths or spiritual gifts that you've had that have led you to be as successful as you are today?
Well, I think that, so I started machine design, automation, and robotics, and it was that problem solver in me that wanted to design and create that led me, and it's a tough road being engineering. And I started out that way. I've been doing real estate for about 3 years less, so real estate's always been a parallel passion, but I think it's that analytical, which, sometimes gifts are also a curse. The analysis paralysis, the engineering analytical guy inside of me has held me back from growing as fast as I should, but maybe not as fast as I ought to, right? So I think that, but maybe as fast as I ought to. So I think that's been helpful. Persistence, I've seen a lot of ups and downs. So, I mean, that's what the book is called. That's why I joined up with the authors to write the Persistence, Pivots, and Game Changers. And I'd say that's probably true because in a high-tech business such as machine design and robotics, we're constantly ups and downs of the innovation in the high-tech world, and also in real estate. I've seen similar waves, and in both cases, I've learned how to navigate my way along those fairly strong.
Yeah, absolutely. And you are, I'm going to plug this now. You're giving away a free copy of that book to all of our listeners with the promo code DST. So if you go to investonmainstreet.com/book, you guys can get a free copy of Persistence, Pivots, and Game Changers. Patrick Grimes over there.
And this is what we'll actually ship you the hard copy too. It's not like an ebook. Yeah, I got a bunch of these. I really believe in the content here. There's a lot of really great individuals that were co-authors. Kind of Phil Collins, lead guitarist at Def Leppard, Russell Gray from the real estate guys, some NFL, NBA players. I mean, it's a lot of great stories in there. I think it's a great addition. I think you'll get value out of it. Happy to share that with your listeners.
Yeah, absolutely. So that's promo code DST. Investonmainstreet.com/book, and you guys can get a free copy using promo code DST. Awesome. All right. So Patrick, talk to me a little bit I think a lot of people are kind of seeing that this downturn in our economy right now, right? Um, I think for a lot of reasons, this is a lot different than 2008. But there's still a lot of fear out there as to what's going on, and there are still people that are losing a lot of stuff right now. And so, how did you how did you go from losing everything to having the capital to start investing in these long term, really conservative plays that aren't returning right away? How did you do that?
Well, so I think that perhaps I may flip the switch a little bit. I started in pre-development, which don't return right away. You're kind of gambling and betting that the market's going to be there by the time you finish the zoning and you start building, that there'll be somebody that can build your property, that hasn't gone bankrupt, that can rent it or wants to buy it from you on the other side of the bridge, that time bridge. And it get caught without a seat. But in our investments now, we start cash flowing immediately about 1 to 2 months in, and we buy for cash flow. It means very low down payments in a way where our vacancies, our break-even occupancies, or the allowable vacancy we have, is so low that it's actually below where we've seen the recessions in the past. Take those workforce housing, existing construction apartment buildings. So I think I kind of went from gamble without returns to immediately start cash flowing, buy for cash flow, but buy properties in the right markets with job and income and employers that are recession resilient and a diversified recession resilient verticals. And we've seen that in past recessions. And those types of submarkets and macro markets allow for some insulation from market volatility. So we'll buy in those kinds, and we'll buy in workforce housing, existing construction, which tends to fare very well because on the downside of recession, people are seeking a little lower cost option. So they're seeking to move out of their prime luxury or single family homes, go into these existing limited inventory of multifamily properties. And so I think for that reason, we're actually buying for immediate cash flowing returns, but we're looking for long-term appreciation, both just in the markets that we're in, but we're buying under market distressed properties that we can renovate to add value and kind of force that appreciation. So we work for it instead of hoping for it.
So how do you so your mindset has totally shifted from a ground up developer to a buy for cash flow and renovate. So what is the number one secret to finding that value add deal?
You know what? I was just on a panel in Chicago on economics, and all the panelists, we all had been through a downturn, and we were talking about that because really there's like 50 different things. And that's one of the reasons why the engineering background kind of lended itself well to getting into this, because the mathematical models are complex when it comes to not only the business plan, but the markets and the economics surrounding both. And so I'd say that when you're in a recession resilient market with growing, with verticals that are recession resilient, with growing income and job and population growth, then you're in tax advantaged areas where legislative friendly, landlord friendly, that are going to attract people, that are going to attract jobs. Now that's where you find the sweet spot. And inside those, you want to look for markets that are growing within the neighborhoods that are kind of up and coming. We want to get the ugly house on the block, essentially, large apartments, 200 to 300 units usually. And so when we find those where we can see a direct link between, hey, this comparable property is similar in size, it's similar in age, it's got similar amenities, but it's just renovated and the rents are $300 to $400 a month. And we can see a direct path by walking the units and saying, look, we can just renovate our units in this building, command higher rents. And that kind of forced appreciation is a very easy mathematical model. Once you've got the right sponsor, you've got the right location, you've got the right asset in the right area, now you've got to find that one where you can see a very calculated risk. And this is about, I think you titled this Calculated Investing in Multifamily. And that does definitely ring true to our side, because it is a much lower risk model than the high tech kind of betting and gambling or on new technologies in the stock market or in new development. You're not creating anything. You're looking at something that's already there and you take a proven path to get there. And so that's kind of what we do. And how the deals come across, well, it's decades of experience. It's a track record for closing. And quite honestly, they're almost all pocket listings and referrals from broker relationships.
Yeah, that makes a lot of sense. And as I get kind of more and more in that commercial space, I'm learning that more. From an outsider's perspective, you can kind of think like it's really hard to find, um, like potential deals, but
Mhm.
it's crazy how many people don't close on a
Oh
property.
yeah. Hmm.
I didn't realize how many people, like, how big of a deal closing and having a track record of being a closer actually is, because they are going to send you every single property first. You're going to get the cream of the crop. You're going to get
Hmm.
the pick of the litter before everyone else,
At a lower
because
price. We
at a
we
lower
just
price.
we just got a 5.25 million discount for the property we're raising capital for today, and we were not the highest price. And it was an off-market pocket listing, but the broker knew these guys can close. They can close in a good market and they can close in a down market, right? Because they have that, we have that, they have that confidence with us that we can perform. And if that broker doesn't get it closed, he's usually fired because he just wasted a ton of that owner's life, or
Yeah.
and the owner's investors are kind of pissed because he overpromised or something, or maybe he has one more shot. So we are usually, if not the first, we're usually the second or the third, because they go for the risky higher offer and somebody trying, the bank won't approve it because it doesn't make sense, and
Right.
but then they come back to us and we're like, we're at 2 or 3 million below the highest guy. They're still going to go with us because on that second try they have to close, and they'll convince that owner to go for that lower price.
Yeah, no, absolutely. It's so powerful being a closer. It's ridiculous. I didn't really realize how important that was until like I started really getting into it, and people were just like not. And I'm like, this is so annoying. Like, just like close on the
Yep.
property you said. Like,
Hmm.
so it's it's super important. So be a closer. That's the number one secret to finding deals.
Yeah.
Right?
Now that said, we walk away from a lot more than, well, I mean, 200 to 300 deals is what we say from the time that we underwrite. We put in LOIs. They come back, say they beat us down. We walk away from way more deals than we ever walked to. We
Of
get
course.
to LOI accepted, and then before we get to purchase and sale, we'll do due diligence, and we'll, and then we'll walk away from those. But it's those times when we say no, no, no enough before we commit, and when we commit, we actually close. The brokers have a lot more confidence because we'll say no first, right, before
Right.
we say yes. And that's the due diligence. I mean, that's looking out for our investors, right? And so, I mean,
Absolutely.
there's numerous times we were in Hawaii for 2 years during COVID, and I was my wife's idea. And so I was red eyeing out overnight to go look at these properties in Dallas and Northern Southern Carolina and Florida that could have been amazing options. And sometimes we just walked them and we're like, no, let's tell them we're not interested. So you got to be real agile on your feet. You got to
Yeah.
work real hard to find those good deals and vet those good deals.
Yeah, interesting. How much do you require um, your apartments to cash flow per door?
Well, so the cash flows are a little different these days than they have been because interest rates are going up.
Right.
Typically, if you look on average over the lifespan of the, say if it's a 3-year refinance where we get your capital back in year 3, but
Hmm.
then we hold for like 5, 7 years. On average, typically we're somewhere in that 6 to 12%. And that's a wide range, right? 6 to 12% average annual cash on cash
Yeah, it's
return.
either it's one or double.
Yeah, but some markets are primary markets where cash flow is a little less. Like in Austin, we just closed this $90 million property in Austin, and the cash flow is a little lower in the first years, but then it grows over time. Some of the, you can get a little bit better in Houston or Dallas, right? Or if you're in like a Cincinnati and Columbus, we don't do deals in the Midwest per se, but we got a 7 cap, huge discount. We were cash flowing, 8, 10% right off the bat. But the real key isn't so much the immediate cash flow for us. It's really a combination of 2 things. One, we want to make sure that we have stability to ride out a recession. So it's really
Yeah.
about the debt service along with the cash flow, and what that break-even occupancy is, right? Meaning that
Right.
what's the allowable vacancy we have and still pay our bills. And if we get that down in that 60 to 70% range, then we know even in the markets we're in, vacancies haven't dropped below that. So we're really looking for that. We're looking for capital preservation first, and then we're looking for, are we buying it enough at a discount? so that we can drive that value up in the first 3 years, de-risk the investment by getting our investors capital out. So then they're passively cash flowing while their investments redeployed, hopefully with us in another market. Now they got multiple streams of income.
Of
And then
course.
Pearson will 1031 exchange them forward, which is one of your sweet spots.
Yeah, absolutely. Okay, so your guys' play then is to buy, renovate, refi. Are you guys liquidating these assets after 5 years, or like what's your strategy in the long term?
Yeah, so our key is to do multiple streams of income for our investors to continue to recirculate their investment and then to 1031 exchange them into additional assets where we can buy it at a discount and then renovate. So we're looking for a great, make your money going in at a discount, then buy it under market rents that need to renovate. So we got kind of both of those levels.
Yeah.
And then pull the capital out, set it back. And then when we go to sell, we exchange it forward. And so, for example, last year we bought 27 million in Jacksonville, Florida, 288 units. It's on my
Okay.
website, Canopy Creek. And the guy, we had to close quickly, 30 days. Guy was ill, wanted to get out of it before, if something were to happen. His partner said, let's just get out of this quickly. So we moved fast. Our investors moved fast, and we locked it in. And it was, all the units were unrenovated, classic, 10 to 15 years untouched, which is perfect
Yeah.
for us. Under market rents by $500 to $600. We immediately went to work, improved the outside, fixed it up, started renovating the interiors as people started moving out. By the end of the year, we had reached our exit pro forma, and we sold in December. Now, we had projected an 18% return over 5 years,
Hmm.
but we had reached it in December. And so we then traded everybody forward to 372 units in Houston, Life at Spring Estates. And so we upped their basis. They cash flowed tax free
Hmm.
all year long because of the depreciation. We
Yeah.
then sold, traded them forward. Now they're instead of say 100% of their investment, they're cash flowing at 170% of their investment in the next deal. And so their basis is higher. And now we're off to the races doing a unit conversion and renovation strategy at that property in Houston. And we'll just continue to trade them up tax deferred, and they can continue to reset their cash flow basis.
Yeah. What is the biggest frustration with capital gains tax as it leads to the 1031?
Well, so in our world, and I have a whole, if you go to investonmainstreet.com/1031, I have a guide because starting out in single family, I started trading through a 1031 exchanges into our larger multifamily assets. And I have an article in Forbes. If you go Patrick Grimes 1031 Forbes, you're going to read it. It's all about how you can go from a landlord with tenants, toilets, and trash, trying to work on a scattered portfolio nearby you, or trying to manage away from you these smaller assets, and how you can trade those, sell those off, and then work as a partner with us. We'll set up a tenant in common, and you can join our investments as a partner. And so many investors from 500,000 to 7.5 million have been putting them as partners into our large deals in the emerging markets that we fully manage. So they're hands off at that point. And so the biggest challenge is educating these investors that are slaving away at their golden years trying to manage properties, educating them like, do you really realize that return on your equity is really low? Sure, you got a really good deal originally. You got a ton of equity now, very little cash flow compared to what we can get you. And we'll continue to recirculate it every 3 years. We'll refi out, give you that capital back. You can reinvest it and continue to keep your velocity to capital high. That's the challenge, is kind of educating them. Hey, you could have a better life, actually grow your basis and leave a better legacy and have a better retirement moving forward. And then doing that in time, because we need them to sell their asset. We need to identify them into one or three of our multifamily deals within 45 days. And then we'll close on one of those three within a total of 180 days. And I think that's just part of the process of educating. I think people start single family. They start thinking a little more sophisticated. They start desiring to have more experts work on their portfolio instead of the control. And then they kind of talk to us, and then we start putting them into bigger deals that are managed by experts.
Yeah, and that's really well said. So, and we were kind of talking a little bit off the show here about this idea of 1031 and the time being really constraining, and that kind of being a little bit of a challenge for a lot of people, and then having to go back into a lot of syndicators won't even touch $1031.
Yep.
I've talked
Hmm.
to hundreds, and they're like, we,
Hmm.
we don't even touch it, and they leave
Hmm.
millions and millions and millions of dollars on the table, for their deals, because it's just too much energy and effort and work for, the amount of the juice really just isn't worth the squeeze for them, and
They
so.
fear what they don't understand, right?
Yeah, and
Yep.
so it's good that you've mastered that whole tenant in common situation, and you're willing to go ahead and pull their $1031 in, because it's a challenge to do. It's technical, and so that's and this is the reason why this podcast exists, right? Because it's cash flow for sure, but it's also tax flow. Like, if
Yep.
you get in your
Hmm.
30% every time your investment is liquidated, you're paying 37% in California, 20% at least in maybe 23% with Obamacare in Florida, right? Or your no income state tax, states. Um, you're still paying 23%. That's a big hit every single time when you can defer
Hmm.
that and increase it. That compounds exponentially. So the tax flow is really important as well. And we were talking about the Deferred Sales Trust, not to be confused with the Delaware Statutory Trust, but the Deferred Sales Trust, which basically allows you to kind of bypass a lot of that work that you have to do in that tenant in common thing, as you're 1031, and you can actually um, eliminate the time constraints and the like kind constraints that follow the 1031. So um, that's the Deferred Sales Trust, allows you to sell highly appreciated assets, which is also really important, is because it can be more than just investment real estate and commercial real estate. You could do
Hmm.
it with a primary home. You could do it with a business. You could do it with stock. You could do it with crypto. We had a guy who sold a business. He got bought up by his partners, $2.6 million buyout. He deferred 600,000 in tax, and he put that money into a 72 unit development deal in Tennessee. You can't do that with a 1031, because it's not like kind. So you can't even do a 1031 for business, or let's say someone has Apple, right?
Apple
And
stock, right?
Apple
Interesting.
stock,
Hmm.
where are you going to put it? You bought it 15 years ago, right? And you rode the wave up, and you want to liquidate it and diversify a little bit. You could use a Deferred Sales Trust. You could liquidate the asset, and you could put a bunch of that money right back into one of Patrick's funds, you know, all tax deferred, without the time constraints, without the like kind constraints. So if you guys want to learn more about the Deferred Sales Trust, go to capitalgainstaxsolutions.com, and you can kind of there's a ton of content, ton of videos, listen to podcasts like this, and make sure that you rate, review, subscribe. We also have a mastermind group that we do every Friday at 10 a.m. Pacific, 1 p.m. Eastern. So be sure to check that out. You can you can see that at capitalgainstaxsolutions.com. So that's another amazing exit strategy for this. I want to dive in a little bit. We talked about the show before the show about the alternative investment space.
Hmm.
How is that going for you right now, especially the oil and gas, um, with all the stuff that's kind of going on, like Russia and the UK? Is that all affecting your guys' funds over there, or how is that playing in a part of this thing?
Well, minimally, the Russia thing specifically, there is some positive impact, of course, not dramatically. Oil's prices are high, gas prices are high, and that's good, right, for us, because if you're direct oil and drilling or oil and gas drilling, then higher prices, our costs don't go up proportionate to the price, so you get higher margins. So it's a great time. It's a hot market right now. Basically, I built this 500 million portfolio in multifamily, and meanwhile, with some of my partners, we had been diversifying in alternative assets. And there's just very well known in a small group of people that these opportunities are out there. And so I had brought a partner on to invest on Main Street to head up the alternative assets division. He's put structured billions of dollars in deals. We found a specific group that we wanted to partner with. I joined the board of that oil and gas company, and we launched a fund and started raising capital we bought existing assets just like we do in multifamily. 135 oil and gas wells with the intent to do value add improvements like we do in multifamily to both rejuvenate the existing wells with various technologies, as well as drill another 23 wells in known proven areas. So not wildcatting out in the middle of nowhere, trying to get rich like Ed Clampett. Now this is just highly probable fertile land and existing leases. So we put all the leases in the fund. Everybody had a piece of the upside of the reserve volume. People have an upside of the oil and gas distributions, and we're off to the races right now. It's going really well. I think the biggest thing, which side note, you can also not only 1031 exchange into our multifamily deals, but there is a component of real property in this oil and gas fund too. So you can 1031 exchange into those as well. So if you're interested, let me know. But I think the biggest thing was I needed to my investors in this time when, say, interest rates are going up, they're a little bit fearful of multifamily. I think that unfortunately, that fear is having them stay on the sidelines where they're affected by inflation. Our deals are not. Multifamily is a hedge. We actually grow with inflation. I think that I wanted to give them another option that's in a completely different market cycle.
Mm-hmm.
That energy, food, and housing are what the government subsidize. Well, we do a lot of housing, the right kind of housing.
Yeah.
But energy is also a very solid way with much greater tax advantages. And that is why I put together a vehicle for my investors to participate. And it took a long time. Oil and gas industry has a bad reputation. Everybody knows somebody who lost money or maybe was defrauded. And I think that's because there's a lot of people just trying to get rich quick in that space. But we put together a low risk way to get diversification and returns as well as the tax benefits by doing half oil, half gas, 135 well portfolio in 7 locations in 5 states. And we're working that now. And I think that's the big difference is we do that heavy lifting of making sure everything's structured right and then with the right operators and push it forward. So very happy with how that went.
How are you guys using opportunity zones at all with those?
So I have a little bit different perspective on opportunity zones. Now,
Okay.
the individuals that are looking at opportunity zones are looking for dramatic tax advantages. And they're thinking to themselves, hey, look, the reason why there's an opportunity zone is because the government is subsidizing to make it attractive to invest somewhere that's not attractive to invest. And in general, you look at the way I talk about investments, landlord friendly, legislative friendly, people are moving there, jobs are moving there, income is growing there, they're on the expansion curve. Well, those are the kind of places where the tide is rising. Now we buy there and the tide is bonus upside for us because we don't project that. But we want to buy in places where the tide is rising. And that has helped in past recessions stabilize economies. Like Houston didn't even drop off in that 8, 9, it leveled off for a while, started going up. Whereas some places like Phoenix and Tucson and Las Vegas, Orlando, they were down for like 12 to 14 years before they even broke even again. And so I want to buy in those places that are resilient, that'll bounce back quickly, and in those submarkets, right? But in opportunity zones, you're hoping for tax advantage. They lock you in for 10 years, but you're not in those markets. So you're taking a higher risk, especially with the recession impact than people realize.
So does that concept apply to the oil and gas as well? Because I mean, the oil and gas is typically rural areas where you're drilling for, a particular mineral, right? And so like if you're pumping the oil out of the ground and you get an op zone, does that change your perspective on it? Or do you have a difference of opinion versus a multifamily op zone versus like the oil and gas op zones or anything like that? Or is it still consistent?
No, I think in general, you want to, for us, because we're not trying to, the tax advantages are already there in oil and gas. If you invest 100 grand with the oil and gas deal, about 66 of it comes off your adjusted gross income in the first year. That is a substantial discount, right, on your taxes. I mean, literally, like the most expensive tax dollar drops by 66K. So it's either pay the taxes to Uncle Sam or Uncle Sam pays you for investing in energy. And that's what's incredible about it, right? So we're not chasing higher tax returns. We're chasing high risk adjusted returns, which means a relatively high return for a low risk profile. Yeah. And oil and gas returns are already really high, right? Why chase even higher ones and take a greater risk? We're buying leases for land in known fertile areas. We're not wildcatting in zones where we're trying to like gamble high to make it big. And I think that's why the concept of opportunity zones of oil and gas is not even on my map, right? I don't want to take that risk. I don't need that extra bonus. My investors don't want that either. They don't want to lose it all again like I did trying to gamble big in 2007 in pre-development, right? They want to move forward on the tried and true wealth building path.
Gotcha. So basically, what it sounds like you're saying is that those op zones for the oil and gas don't have known reserves in there that are going to yield the returns that you guys have. Whereas you guys are just buying, you know what you're buying, and you know what you're going to get, and you know there's a super low risk profile with it. And so because of that, you're willing to take a little bit lower. The returns are already super high, but within your risk tolerance, this is the market you're going after. Makes sense. Okay, cool. All right, we're kind of coming up on our time here. Where can people find you?
Yeah, so if you go to investonmainstreet.com, you'll see our website, our latest investments at the top. This is a live stream, so I'm assuming people are looking at it. We're a syndication, so 506C Reg D, which means I can share with you directly about our investments. We're raising capital right now for an investment in Atlanta. It's an awesome opportunity. Got it, $5.25 million discount. Great returns, 8 to 10% cash on cash, 17% overall average return over the hold. Love to have you involved. You can opt in there. We also have a bunch of free resources. We've got articles, a bunch I've written at Forbes, Passive Investor Guide, a lot of content on our website at investonmainstreet.com. And send me an email, patrick@investonmainstreet.com. Love to chat with you. I still take time to meet with all the investors that come in the door. I'm a relationship-based individual. So if you're an accredited investor or interested, set up a chat, shoot me an email, and we'll connect, see what your goals are, and see if we're a good fit.
Awesome. All right. And don't forget to go get a free copy of his book, Persistence, Pivots, and Game Changers, by going to investonmainstreet.com/book using promo code DST. That's promo code DST. If you want to learn more about the Deferred Sales Trust, come to our mastermind group every Friday, 10 a.m. Pacific, 1 p.m. Eastern time. It's a fantastic place to come ask questions, bring your CPAs, bring your financial advisors, your accountants, all those people, right? Come ask questions, learn, and make sure to register for that. If you want to get in touch with us, you can go to capitalgainstaxsolutions.com, and there's a ton of content on there. Check out our YouTube channel, and keep listening to the podcast. Patrick, thanks so much for coming on, man. You added a ton of value. Really appreciate your time. And we'll see you on the next one. And thanks again, everybody, for listening to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy, and using proven tax deferral strategies such as 1031s into tenants in common with Patrick and his funds, or using a deferred sales trust, is the best way to exit highly appreciated assets tax deferred, so you can create, preserve, and grow your wealth. So please rate, review, subscribe, share, comment, like, all that stuff for the interweb algorithms and all that other stuff that I don't understand. But I just know that you got to do it. So it helps us out greatly. So we really, really appreciate it, guys. And thank you so much. And we'll catch you on the next one. See ya.